Hello traders, Gary Wagner here. It is just after 11:30 in Honolulu, 5:30 in New York on Friday. Happy Aloha Friday, as we say on the island, 10th day of June 2022, and this is the daily report for gold and silver, our weekend review. Economists polled by Bloomberg, Reuters, and the Wall Street Journal all underestimated the strength or the rising level of inflation as the CPI came out today, revealing that inflationary pressures are at the highest level since December of 1981. A minority of the analysts, including myself, have been proponents for quite some time that the Federal Reserve was either living in a bubble, entertaining an absolute fantasy, or outright lying to the American public by saying that inflationary pressures first were transitory, then shifting up and say they might be a little bit more sticky, and then moving to the doctrine that they believed that they could control and reduce inflation by the end of the year, taking it back to a 2 or 3% target. And they're comparing that to the core inflation rate, which is currently sitting just at 6%. This obviously is an impossible task at best. And according to the legendary David Einhorn, founder of one of the major American hedge funds, said the Federal Reserve will likely cause more damage than good with their aggressive monetary policy. More on that later. Today's CPI report indicated that inflation last month rose to a 41-year high, 8.6%. It was an extremely volatile day in gold, but gold did close higher to the tune of $22.40, or a 1.21% rise, currently fixed at $1,875.20. And the real information is that while gold rose $23 in terms of spot gold prices at $1870.90, the dollar also rose approximately 1% on the day. And so when we put up the Kitco Gold Index, as you'll see right now, you'll see that gold itself without dollar strength would have risen much higher. This first chart is a short-term 10-minute candlestick chart of gold futures. The futures market opens for trading at 8:30. That's represented by this candle right here. Gold opened at 1850. And traded to the low of 1826.50, all within the first 10 minutes of trading. What followed was a small dip and then a slow and methodical rise up to the highs of the day. The high itself came in at $1,879.60, and as I said, is currently at $1,875.20, and you can see how that flattened out towards the end of the trading day. We went into today's trading activity flat in futures and Forex long in our GLD position. And although we highly anticipated that gold would move higher, we were also acutely aware of the strong potential for extreme volatility, that kind of whipsaw action or knee-jerk reaction to the report as it came out. We certainly got that today. We are looking at a daily candlestick chart of gold futures. In that chart, we have included a Fibonacci retracement data set, as well as three major moving averages, 200 in red, the 50 in green, and the 100-day simple moving average in blue. We also have included a trend line, and that trend line has been a guide for us up till today's activity of recent lows. It showed that we've had a series of higher lows, but the reason that we were reluctant to make any kind of action today was the fact that we had this exaggerated low, that knee-jerk reaction to today's report. So the fact that today's report came in at 8.6%, showing that last month's level of inflation exceeded the forecast by the majority of economists polled by Bloomberg, the Wall Street Journal, and Reuters. How will that change the future guidance of the Federal Reserve? Of course, they meet next week starting on Tuesday. My sense is they will continue to raise rates by 0.5%, 50 basis points, at many, if not all, of the remaining FOMC meetings this year. I don't think that they'll move to a more aggressive stance in terms of the rate hike per FOMC meeting. They'll want to have one thing constant, but I think we're in store for multiple rate hikes, more than we anticipated before today's report. So what does that mean in terms of our trading strategy? Obviously, we had a tremendous kick to the upside today. Gold closed very near the highs, and they are closely approaching what I consider to be a triple threat in terms of resistance. You can see that the 50-day moving average has crossed under the 100-day. I think it will whip right back above it, and that also corresponds to the 61.8% Fibonacci retracement at 1893. The fact that all of these technical indicators coalesce at a solid price point tells me that we will see gold continue to rise next week and could easily find major resistance in the market at approximately 1890 to 1895. At that point, we would calculate what the pullback could be and look to reposition ourselves from the long side when we feel that a very shallow and quick retracement has occurred. We're going to play you parts of yesterday's show, specifically comments made by David Einhorn, the founder of a major hedge fund. As you know, many analysts, including myself, have for quite a while maintained that the Federal Reserve cannot in any way curtail inflationary pressures due to their root causes. However, today it was hedge fund founder David Einhorn that put it incredibly succinctly in a speech that he made in front of a hedge fund conference. During his speech, he made a very interesting and profound statement as to why he believes that gold will begin to rise amid the current environment of rising prices that he says the Federal Reserve cannot curtail or reduce. Unquestionably, today's CPI inflation report, coming in well above expectations of the vast majority of analysts, created a knee-jerk reaction in which first market participants reacted to the high level of inflation and considered future guidance of the Federal Reserve. That's what took gold lower. On careful consideration, they realized that, as David Einhorn spoke about, they most likely are not going to have a dramatic effect on reducing inflation, and in fact could make the scenario worse, and that's what moved gold higher. It's been an interesting week, to say the least. This has been Gary Wagner wishing you, as always, good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.